Okay, you're welcome to today's lesson, components of smart money concepts. Number 4, order flow. What is order flow? Here we are going to try to understand what an order flow is and how to actually identify and trade it for profit on the chart. An order flow is the last selling potential before a buy and move upwards, which can enable price to come back, retest, and continue the trend. This is for bullish market. For bearish market trend, the last buying potential before the selling or drop. As I'm going to show it here, the definition may be confusing, but this is how it is. This is an uptrend. The market is going up. Now, we are anticipating price to come down if there's another block here. This entire range, after this break of a higher high, this is higher high, as we are in an uptrend, and this is an higher low. Price move up from an higher high, came down from lower high, then move up to break above this higher high. Now the range between the higher high and the higher low that price broke out from is called an order flow. This is an order flow, identified as OF for a bullish trend. Now when we are talking about a bearish trend, it's also the same thing for bearish trend. Price is moving downward. When price form a lower high, this is a lower low and this is a lower high, since you are in a bearish momentum. So therefore, the range between the lower low and the lower high, the space in between here is called an order flow. We are going to see pictorial representation of it. As can be seen here from this chart, we have learned about impulsive move, corrective move, impulsive move. This is a downtrend, so therefore the first impulsive move, the point that the price is going to reverse from this point, we are going to call it lower low. Since we are in a downtrend, so we'll call this first point lower low. The first point that price will trace from, make a corrective move. Then when the price is coming down, make an impulsive move again. This point we are going to call it a lower high. So therefore, the range between this lower low and this lower high, then when price broke this lower low downward, the range between it, this space, this gap, is going to be called our order flow. As such, this is an order flow. Now let's take a look at the candle formation. When price make a corrective move, then price came down to break this lower low. You can see that this candlestick, it was candlestick B that broke the lower low, right? Candlestick B broke the lower low, then candlestick C make another formed after candlestick B, right? So you can see there's an imbalance between candlestick B and candlestick C. When you make a straight line to the left from candlestick C wick through the body of candlestick B, as you can see, there is an imbalance in between there, meaning that this full range is a valid order flow. Price has not mitigated this order flow already, because there's an imbalance between this candle that formed after this candlestick that broke the lower low. So price make a formation like this. Price went up, make a retracement, which is corrective move, went down, broke below here. When price broke below it, it formed another candle, leaving a gap in between. So therefore, we can anticipate price that when price has formed this next candle after the candle that broke the lower low, this is the lower low, this is the candle that broke the lower low, right? Then price form below it, this is C candle. When a C candle formed, there is an imbalance that was created, so we can now anticipate price to come back into this order flow to make a move, which is a retracing, a corrective move, and then price can now continue to go downward. It is not a perfect way to trade, but it's very good to know it. This is what we call an order flow. This is a valid order flow, as I have mentioned here. Now coming to this place, you can see this is an invalid order flow. What do we mean? Price was making a downward movement, retrace, which is make a corrective move, and then when price broke the lower low, this is what happened. This is the candle that broke the lower low, candle B. Then when candle C now formed, when candle C formed, you can see the wick of candle C that formed already tapped on this zone, on this order flow, meaning that this order flow is no longer valid. You can no longer use this order flow because it has already been mitigated. There's a mitigation with this candlestick C wick. This candlestick C wick, when it was forming, already mitigated this order flow. This is the entire order flow, as you can see it. So candlestick C wick mitigated it. So when another candle formed here, we cannot expect it to come back to this place. Even when it comes back, this is no longer our valid order flow. We just allow market to do its thing. Market may probably come down or continue to go up. Okay? All you have to do, practice on the chart, try to identify, as I've mentioned here, you will get used to it and you can be able to practice and know it. Okay. Okay, as we normally do, this is our fourth assignment. Mark on the chart 5 valid order flow and 5 invalid order flow. A valid order flow is an order flow that has not been tapped already when the candle broke it. The next candle that formed after the candle that broke the order flow did not tap on it. Then we can anticipate an order flow. When the candle tap on it already, the next candle that broke the lower low, when that's in a bearish trend, the lower low, meaning that if the candle did not tap it, that's a valid order flow. But if the candle tapped on it, that is an invalid order flow. We can no longer use that as a valid order flow. Watch the video over and over again, practice it, do this assignment, send it for review so that I can be able to guide you so you can be getting better at this. Thank you very much.